Welcome everybody, and thanks for joining me here today. My name is Edward Modla from the Options Industry Council. Going to teach the first of two parts on the Greeks. I hope first of all that everyone is staying safe and navigating this year as best you can from both a health and financial perspective. Hope everyone is doing well. I'm going to get started today with what I consider to be the easier session of the two. Oftentimes, delta is the first Greek people talk about, but because it's so closely attached to gamma, and gamma sort of gets people maybe the wrong way, and maybe takes a little more time to digest. I've decided to go with Theta, Vega, Rho today for session number 1, and then session number 2 in a couple of weeks we'll finish up the Greeks with delta and gamma. My background a little bit goes back to the late 1990s. Went to the University of Illinois up in Urbana-Champaign and graduated with my finance degree. As soon as I graduated, went right to the trading floor and worked for Blair Hull and his trading firm, arguably the largest options market making firm on the trading floors in Chicago, New York, San Francisco, Frankfurt, Germany. We were all over the place as a professional firm, worked for them for a number of years, transferred to a smaller market making firm, got into the equity options pits in Chicago and really enjoyed my time down there. I'll reference that at least once today. And then moved into an independent trading role for a number of years. Spent some time in the futures markets, and for just over 5 years, been with OIC, the Options Industry Council, teaching the options product. That's what we do. We are a nonprofit, free educational resource for investors to learn about options. Here is our disclaimer, and where I wanted to start today was looking at volume. Since it's been such a crazy year, I did want to take a look at where volume is and where it has been. And of course, we have the explosion of the industry and a highly volatile year in 2011. But then these record-setting years, 2018, 19, centered right around that 5 billion contract a year level. 5 billion, by the way, if you average that out, it comes out to about 19.8 million contracts traded per day, and that's that record-setting level that we saw right around 2018 and 19. It's hard to keep track exactly where we're at. 2020, things are volatile, things are moving around, but as we speak, last time I took a snapshot, we were on pace to go up to about 7 billion this year, way up here in 2020. That's the pace we're on, about 27.5 million contracts traded a day. That will put you way up at 7 billion. You can see just how much volume there's been in the markets, in the options markets so far this year. Certainly we know why this is happening. It's not a time to celebrate what's going on, but certainly a time to reflect on the fact that options are used as a versatile tool in so many ways, to reduce risk, to hedge portfolio, to use in conjunction with stock, or to speculate, do all of those things. And when markets are stressed and investors are looking for that tool to help them navigate the environment, the options product certainly comes to light. Also, one month that stands out to me, March of this year, the volume was about 670 million contracts, puts you right up here. You can just see since the inception of the industry in '73, the industry didn't get over that level on an annual basis until 2000 or so. And that was the amount of volume we saw just in March of 2020 this year. So people are using options, and there's good reasons why. As I said, we're going to start our Greek series today, talking about theta. First of all, the rate of decay is important, the difference between near-term and long-term. We'll move into Vega. Inherently, there's a discussion on volatility that has to occur, so we'll define and compare historic and implied volatility, look through an example of Vega in action before and after earnings, and see how that plays a role in those circumstances when volatility change a lot. And then we'll close it up with Rho, the Greek that gets the least attention, and for good reason. But we will have a definition and explain where and when it is relevant. The Greeks, notice we say first order Greeks, there's 5 of them, and we'll cover delta and gamma next week. Gamma tends to be the hardest one for investors to understand, but coming from my background as a professional trader, gamma has the most information. If I could only look at one Greek, I only get one, I'm picking gamma, and I'll explain in session 2 why that is and what that's all about. Today's session on Theta, Vega, Rho, I think this is relatively easy to understand, and these concepts you're probably already implementing in your options analysis, whether you know it or not. It's just a matter of terminology and understanding what these words mean. Also, with regard to first order, there's a lot more Greeks than just this. There's second order Greeks, third order Greeks, and a lot of them are trying to compare as one Greek changes what happens to others. And you can make this as complex as you want. In fact, not too long ago, a colleague of mine on the OCC risk management team who works on their pricing and margins group sent me a list of third order Greeks and said, Ed, can you help me understand what these are? And I looked at them and I wasn't familiar with any of them. And so I said, sure, I can help you, but give me some time to look these up and find out what they are for myself, because I wasn't sure what those names were referring to. But for our purposes here and for most investors, the first order Greeks having a grasp of these five, really these four, delta, gamma, theta, and vega, will give you enough to work with as you're evaluating price. And that's what we're trying to do, is evaluate the price of an option and how it might change over time. Pricing models are what are used to generate theoretical values. Go back to 1973. The SIBO launched standardized listed options contracts in 1973. Also, the Black-Scholes model was published in 1973. Prior to that year, there was no pricing model, and options investors had to use more intuitive analysis to decide what they thought an option was worth. Well, now there was mathematical formulas behind those theoreticals, and Black-Scholes was launched in 1973, really used for European options, American style options, which are equity and ETFs, would use a variation of that. Quite frequently, Cox-Ross-Rubinstein is the pricing model used by a lot of investors pricing the American style options. And very simply, to describe what that model is doing, it's a binomial model that takes today's stock price and assumes it can either go up or down from today's level, and then from those other two potential levels, it can go up or down from there, and then you can keep going. And if you're visualizing this branching out one level at a time, you have all these future potential stock prices, and you can calculate an option value at each one of those levels. And when you compute that level, you can compare it to the intrinsic value at some point. And in some of those circumstances, you might find that the intrinsic value is greater than the calculated option value, and that would be those circumstances of early exercise. It's American style, I'm going to early exercise it, and then you increase the value of the option from its theoretical to its intrinsic. It's not too important if you understood all that, but that's how the binomial model implements American style and early exercise. More important to today's discussion about Greeks, these models need inputs: the strike price, the stock price, the days to expiration, the volatility level, and the interest rate and dividends, if any. All of those inputs need to be inserted in order to calculate an option's price or its theoretical value. Each one of those inputs, with the exception of the strike price, the inputs of stock movement, volatility movement, days to expiration changing, interest rates changing, each one of those variables changing will affect the theoretical value, and Greeks are trying to predict what kind of effect is that going to have. Options are not like stock. Options have expiration dates, and options have premium and time value, and you have to understand how those premiums change over time. Greeks are a way to predict or get an idea when the stock price changes or volatility or time. What does that mean for my options price? And again, whether or not you're thinking of this in terms of Greeks, there's a pretty good chance you're doing this kind of analysis if you're evaluating an options price. You see something out there, you're thinking of buying it, it's trading for $3, and you're deciding, well, is that too much money? Do I have enough time? How high would the stock have to go? You're doing a Greek analysis in there without necessarily attaching the terms to it or without realizing it. So that's what we're trying to accomplish with looking at the Greeks and understanding them. Gives you an idea as those variables change. What does that mean for my options price? I'm going to start with theta and time decay. First of all, by definition, and then with some insight and some commentary. Theta is the option value sensitivity to time, more specifically, the expected time decay in option value with the passage of 1 day, expressed in direct decimal form, the dollar amount that theta is predicting the option will decrease with the passage of 1 day, and that's calendar day, not trading day. So it is true that over the weekend, 3 days of theta come out of the options price. However, just be careful. There are some investors that like to sell on Fridays and Friday afternoons thinking they'll get 3 days of time decay. And that's true. It might work out, but keep in mind there's a reason why it's per calendar day. There really is 3 days of risk for something to happen in this world that could affect the market, the industry, or the stock itself that you are trading. So you are taking weekend risk. It's not as if the world stops on a Friday afternoon and then opens back up on Monday. Also, professional traders who are making markets, they know 3 days of theta is coming out. And if they perceive little risk of weekend activity, and I can speak to my experience on the trading floor, I started to reduce my options values on Friday morning, especially if the market was slow and there wasn't much activity. By lunchtime on Friday, I was lowering the days to expiration by 1, 2, and by Friday afternoon by 3 days. And I was looking at option values that reflected 3 less days until expiration. So it's not so easy to just think you're going to sell Friday afternoon before the bell and have a good chance to be profitable Monday morning. It's a little bit more complicated than that. One thing is that you'll find with all of the Greeks, there is an assumption that all other pricing factors constant, which is not true. In fact, theta itself, or each Greek itself, is not constant. As the market moves, each Greek is changing. So again, these are expectations, ways to predict, ways to get a grasp on what might happen to the options price, realizing there will be some margin of error because the other pricing factors will not be constant. And then with respect to calls and puts, both have negative theta amounts, or you could say that generally when you buy a contract, you suffer from time decay. You own a contract, generally speaking, with each passing day, you lose value in the sense that theta decays your option, and selling is usually attached with a positive theta position, or the gain in value as you sell options. Looking at an example, starting out at the top, an options trading at $3.50, and it is just simple arithmetic. The theta is 3 cents. You have your contract aggregate value, and with the passage of 1 day, all else equal, theta is suggesting that the option value is going to decrease by 3 cents and go down to $3.47. Expected value 10 days from now, $3.20. That's simple arithmetic. 350 minus your 10 days of decay. But I can tell you this is not going to be right because it's going to change. It's going to be fluid and it's going to constantly change, and this number will not be accurate. However, it gives you some forecast of what might happen to this contract, although you know over the course of those 10 days, not only will all market factors likely change, but theta itself is not going to be 3 cents every day. So you have to keep that in mind and have to keep repeating here, assuming all other pricing factors remain constant. Let's look a little bit deeper now into time decay. A lot of you have probably seen this type of a graph, and what it shows is the acceleration of time decay in an options contract. In the money options, to start here, the in the money contracts have very little time value, very little extrinsic value, and so their decay is more linear as these contracts more gradually gravitate towards parity or gravitate towards their intrinsic value. So in the money options, you have this slower, more linear time decay, but at the money options behave differently. At the money options, when your strike price is equal to or very close to the underlying value of the the stock price in the open market. Now, when you have a lot of time to expiration, the decay is slow, and then there's a tipping point here, roughly 40 days. Some educators may say 35, some may say 45, or be more specific than that, but around this 40-day level, you have a tipping point here where the stock price or the option price starts to decay much more rapidly, and that rapid decay will continue through expiration. And the fastest amount of decay you're going to witness is going to be expiration week or expiration day, when time value amounts quickly approach zero. Now, when you're selling options, this is what you want to capture, as fast a decay as you can possibly get. However, when you get really close here, that's the fastest amount of decay, you also will have relatively low premium amounts. A nickel or a dime or a quarter, it might not be worth selling if your risk reward is not going to pay off, even if the decay is quick. So you have to try and find that sweet spot where you have enough premium to make it worth the obligations and the risks that you're taking, while still catching a quick amount of decay. And I want to drill a little bit deeper into this thought. Just reminded me with respect to cheap, out of the money put options as expiration approaches. When I was on the trading floor, I never sold cheap put options. It depended on the product I was trading, what level that would be, but you could say a nickel or a dime or sometimes even a quarter. Just wasn't worth it. Didn't matter how much time there was to expiration. It's not worth selling those options for the risk that you take on for such little return. And you'll find that generally to be the case for those cheap put options approaching expiration. The nickel bid doesn't disappear. Money managers, investors, and institutions are likely willing to pay a nickel to satisfy some downside risk exposure and maybe improve their capital position, even if there's not much time to expiration. So you'll find that tendency for nickel bids and dime bids and quarter bids to not disappear as you get closer to expiration. What that means is the theta amount is wrong, or it turns out to be inaccurate, and there's circumstances for that. And this is one you'll probably see regularly if you haven't already noticed it, that theta of a dime, option trading for a dime, is telling you this option should decay by a penny or a penny and a half, and it doesn't happen because those dime bids don't go away and don't disappear. And now to foreshadow where we're going this with volatility, if that happens, think back to the pricing model. You have all the inputs: strike price, stock price, volatility, days to expiration, interest rates, and then you end up with the option price. Well, the option price isn't going anywhere. It's a dime today, it was a dime yesterday, it's a dime tomorrow. The stock and the strike are staying the same, and the days to expiration are decreasing. The only way to make that math work is to increase implied volatility levels. If the decay in the option is not what theta suggests it should be, you will likely recognize that implied volatility levels are going higher. It's the only way you can make the math work in the formulas. That's another thing you'll notice. Approaching expiration, the volatility levels of cheap out-of-the-money put options tends to gravitate higher. And for those of you familiar with volatility skew and the volatility curve, the curve will likely get more steep as those cheap out-of-the-money put options do not decay. I guess this drives home the point that these Greeks are in theory, they are theoretical, they try to predict, but the open market does different things, and you have to understand that as well. I want to do a knowledge check, just a few questions. I'll add the complexity as we go along. We'll do this for Vega too, but just drive home some points. Here you have stock trading at 100, and we're long the 90 put spread, bought the 95 put, sold the 90 put for 50 cents. Does theta, or time decay, help or hurt this position? Pretty straightforward. I hope everyone could say that it hurts the position. We bought this spread, paid 50 cents, and the passage of time is going to hurt this position. If the stock doesn't go anywhere, then we'll suffer from losses of days to expiration. How about this one? Long 80, the in the money 80 strike calls, we pay 20 1/4, or long the 85 strike put for 40 cents. Stock's at 100, and here's our two positions. Which of these positions is more affected by time decay? As one day passes, which of these two positions is going to suffer more. Similar to the above answer, the 85 strike put. It's closer to at the money. At the money options have the greatest time decay and greatest theta, and also the time value itself. I'm sure many of you did the quick arithmetic. The 80 strike call is $20 in the money. That means there's only 25 cents here of time value. The 85 put, all of that for the out of the money option, all of that 40 cents is time value. So the 40-cent option will suffer more from time decay. Now let's look at something else a little bit further. Is it possible to buy an option and have positive theta? I said earlier that generally when you buy options, you have negative theta because the passage of time is working against you. And when you have a short option position, it's positive theta. The passage of time is working in your favor. So is it possible to buy an option, pay for it, and have positive theta, where the passage of time is working in your favor, or you could say the value of the option is increasing? And this answer, this question is a little more in depth, but the answer is yes, it's possible in a general sense. Before I get to the specific example, in a general sense, if you are able to buy an option below its intrinsic value, then over time with each passing day, the option value should gravitate towards its intrinsic value or gravitate in your favor. And that's the general explanation. But more specifically than that, what you might notice regularly is this occurrence for deep in the money European put options. Now, buying something below intrinsic, a lot of you probably said, well, yeah, good luck with that. The answer here is really a trick question, because we're not talking if you get lucky. But specifically with deep in the money European puts, you might regularly see this happen. And why is that? So European puts, you can't exercise European options before expiration. So if you have a deep in the money put option and you buy that option, you have to hold it till expiration. Of course, you could sell it early, but that's not going to affect the theoretical value. You can't exercise early. That cash outlay, all of that money that you no longer have in your account, that you can't earn the risk-free rate of return on because it's tied up in this put option that has a 100 delta that's going to provide the same risk profile as if you exercised the option, but you can't. So if that's the case, and you can think of an extreme example, and you might see this in SPX options when you're looking through your options chains, go way up there to the deep 100 delta puts and see where they're trading compared to intrinsic value. At some point, you're likely to see they're trading for below intrinsic, because investors and certainly market makers aren't willing to pay for an option that's very expensive if they can't exercise it early because of that cash outlay up front. That debit up front costs them something. That is the risk-free rate of return, or the cost of carry. And because of that, you might see deep in the money European puts trade below intrinsic, and then with each passing day, the value of that option will gravitate up towards its intrinsic value. In that case, you certainly could say that you bought the option and have positive theta. It's likely you're not going to come across that situation or trade such an option, but from an educational perspective and understanding what theta is and how it works, I think it's helpful to outline that. Let's move forward, and I've already foreshadowed a bit on volatility and Vega, so let's get into it. Can't separate these two, but implied volatility is not a Greek, by the way. Vega is the Greek, implied volatility is not, but the two go together. So let's define historic and implied by comparing the two. Historic volatility is a stock's volatility in the past. It's factual, it's looking backwards in time, and can serve as a reference for investors to try and predict what the future volatility of a stock is going to be. You can choose different intervals of historic volatility data. You can choose the last 10 days and calculate what's the historical volatility of the stock over the last 10 days, or 30 days, or 90 days, or 100 days, whatever you want. And I think 30 days is very popular to look back over the past 30 days and track what the stock has been doing in an attempt to look forward at what the stock will do in the future. Options care about what's going to happen in the stock between today and expiration date. They don't much care about what's happened in the past. That's a reference, but they'll be priced off of an expectation of future stock price movements. And you can use historic volatility along with any concerns, anything on the economic calendar that's coming up in between today and expiration date to come up with an implied volatility level. By definition, implied volatility is the level that justifies an options price, and you can determine this with an options pricing model or a calculator. We have a calculator on the OIC website where you can do just this. I outlined before all the inputs into a pricing model, and the result is the options price. However, we can observe the options price. We can look on our chains and see what the bid ask is and what the last trade is, and insert the options price and then solve for implied volatility. And that's something one of our calculators can do. Insert the price, hit calculate, and it will then reflect to you what implied volatility level is associated with the options price that you put in. And again, it's reflecting the underlying stock volatility looking forward or expected by the marketplace, and is determined by anybody. The bid ask and the supply and demand of the market determines where those prices are and will set ultimately those implied volatility levels. Back when I was on the trading floor, I started every trading day with an assumption of implied volatility levels. The more uncertain I was about where those levels were going to be once the opening bell rang, the wider my markets were, the wider the bid ask was, and the smaller my size was. I worked for large trading firms, so small might have been 25 up. I'm 4 even bid, 4 5/8 offer. I was on the floor during the fractions, and maybe I was 25 up, and that was small. And then once the opening bell came in and we saw supply and demand and some order flow back and forth, eventually I could toggle my volatility levels to where the market was telling me they belong, and then at some point settle into where I was comfortable. The bid ask gets tighter, so now maybe I'm 4 1/8 at 3/8, and I'm 100 up instead of 4 even at 5/8 and 25 up. And that's watching where the supply and demand is. What side is the order flow coming on, moving implied volatility levels to match. And sort of the way I describe it is discover that level where there's no trading, where I'm not getting all buys, I'm not getting all sell orders, I'm getting a mixture of both. That level of neutrality, that's what the market's looking for, and that's what market makers are trying to find. So let's move forward now and discuss the impact on options prices with volatility. Changing volatility, it's going to happen all day long. This is the great unknown, and a change in the historic volatility that may or may not affect an options price. When something happens and it's historic, well, now it's become factual. That could change future expectations, but not necessarily. But while everything else constant, a change in implied volatility will affect options prices. If volatility increases, that suggests a wider range of potential stock prices in the future, on the upside and on the downside. So both call and put prices increase as volatility increases, and the opposite effect as implied volatility drops. Then the range of potential future stock prices will narrow or shrink, and both call and put prices will decrease. And as I said, we were changing these levels of volatility all day, every day on the trading floor, opening every day with some level of uncertainty, and then slowly getting a better feel for where volatility should be as we saw the order flow. Now that's implied volatility, and changing that level. If you want to forecast what changes in implied volatility are going to do for the options price, that is where you enter the Greek. Vega as the Greek is the options sensitivity to volatility. More specifically, it's premium changes, or the expected change in the option value as you witness a 1 point change in implied volatility expressed in decimal form. This is numeric, represents cash amount per option, and assumes all other factors remain constant. If you're trying to look out in time and analyze what might my options contract be worth 2 weeks from now, given a certain stock price and a certain volatility level, you can use a calculator to predict that level. It's a question I often get. I say, Ed, I bought this option today. It's got a month left till expiration. If the stock goes up 5% and I've still got 2 weeks to go, how do I know what my option is going to be worth? The answer is you don't know, but you can use a calculator, inputting that expected stock price and then entering in an expectation for what implied volatility level would be 2 weeks from now, given that new stock price, and calculate expected values. And I suggest when I answer this question is change those levels. Move volatility up, move it down, move it in big directions either way, so you get an idea of just how much of an effect it's going to have on your option price as it moves. So Vega is the Greek indicating the expected change in the option as volatility moves, as implied volatility moves. Calls and puts both have positive Vega, which means as the buyer of options, doesn't matter what they are, calls or puts, if you buy options, you're long Vega, and you would experience a positive effect on your account as implied volatility goes up. And if you're selling options, doesn't matter if they're calls or puts, you are short Vega. You're selling positive Vega to someone else, meaning your position is short, and you would be looking for a drop in implied volatility to have a positive influence on your options prices. Let's take a look at an example that I use these numbers taken from an options calculator prior to earnings. This is just a random stock XYZ trading at 100. Days to expiration 13, and starting out with an implied volatility level of 50%. Here you can see where the Vega is and where the other Greeks are, but most importantly where the stock, or where the option value is. Based on these inputs, here's your stock at 100. The 105 call leaves you with an options value of 185. So now you have earnings come out. And if you bought this option, you're looking for a move higher. I get this question all the time. I bought a call, earnings came out, stock went up, I lost money, what happened? And investors often think they're getting ripped off, or is the market stealing from them? But that's not the case. Post earnings here, you have a 5% move, and we're a week later, and implied vol has dropped by 20%. Now this dynamic of all the Greeks, they're constantly changing. Vega's constantly changing. You have the positive influence on your options price with the stock moving higher by $5. That has a positive influence on the call, but doesn't mean the call is going to be worth more than it was when you bought it. You have less time. Volatility is much lower. So given all these inputs, you lost money. A 5% move higher in the stock resulted in a loss. And I give this example usually in a similar context of not making money or losing money, because that's the context of the questions that I get. But this certainly isn't meant to imply that it's suggested you don't buy options before earnings. The idea here is this move wasn't enough. It's quite possible that you buy this option with the stock at 100, thinking stock's gonna go to 110 or 112 or 115 after earnings, and that's why I'm buying it. I know I'm paying 50% implied vol. Get out your calculator. You can go out 1 week, drop the days to expiration by 1 week, move the stock wherever you want to, 110, 112, 115, and then drop implied vol. Drop it to 40, drop it to 30, drop it to 20, and see what kind of values you get. And by doing that exercise, I think you'll have a better idea of the kind of stock move you need in order to be profitable on your trade. It's even better if you have some history with trading options on that stock, and because you have knowledge of what implied vol levels generally are before earnings and after earnings. Then you can do this exercise with a little more clarity and confidence in predicting what type of stock move do you need to be profitable if you get this 20% move down and you're paying $1.85 to start. that calculator can be really helpful if you're doing that type of analysis. But then again, the other key point here is the conflicting influences on an options price. Positive influence on the call by the stock moving higher, but negative influence on the Theta and the Vega as well. Let's look at a few questions. Again, nothing too complex here with Vega. Looking at the 100 strike call, is Vega greater on a contract expiring in 5, 30, or 90 days? That really short term, moderate term, or long term. And Vega, by one of its characteristics, is that it is greatest the further out in time that you go. The longer dated options have greater Vega amounts. They're more sensitive to volatility changes. So the 90-day option in this case is going to have the most sensitivity to volatility changes. The iron condor trade, investor puts on an iron condor. For those of you who might not be familiar with that, you're selling a call and a put, let's say close to the current level of the stock. You sell a call and a put, and then you go out further than that and you buy a call and a put at wider strike prices. So you're selling two options and buying two options. Does this position have a long or short position in Vega, and will an increase in Vega help or hurt the trade? Well, again, here, you're selling the options that are closer to at the money. The Vega there will be greater than the wider striked, cheaper options. So to put these two questions together, Vega is greater long-term and at the money. And in the case of the iron condor, you're selling those options. That puts you short Vega, and an increase in volatility in Vega will hurt the position. And then let's look at the last one, somewhat of a subjective question, but I think you can generalize here. If the stock drops 15% as a result of some company news, are long or short Vega positions likely to have a positive impact? Would you rather be long Vega or short when something like this happens? And the answer is long. There could be different things that go on here, and they could involve the volatility curve and the skew, and you could have an option sliding up and down the volatility skew. But generally, the idea here is that moves lower in stock prices are often synonymous with increases in volatility. And as volatility increases, you'll have a positive impact on your option prices if you have long positions. So long positions are likely to be positively impacted as a result of this drop, which is most often also associated with an increase in implied volatility levels. I'm going to finish up this first session on the Greeks with a few words about Rho. Not a whole lot on Rho and interest rates, just broad strokes on what it is. Rho is the options sensitivity to interest rate changes. The expected change in the option value with a 1% point change in risk-free interest rate. And this is one reason why Rho doesn't get a whole lot of attention, because the number, while sometimes not significant, is also attached to a 1% change. It's not too often you get 1% changes overnight. So the effect from one day to the next tends to be very minor and sometimes unnoticed, even when there are changes in interest rates. But it's important. It's a required component in the options pricing model. And the number you see represents cash amount. Again, like all the other Greeks, it assumes other pricing factors are constant, and it is considered the least significant. It has to account for cost of carry, more on that in a second, and represents a small, generally speaking, a small portion of the options total premium amount. And again, even if you do see interest rate changes, they will likely be at some small fraction of 1%. That's not always the case, but 1% move or some fraction of tends to not show a whole lot of difference. Although Rho is important, you won't notice it a whole lot in prices with changes. Calls have positive and puts have negative. Now, one of the ways maybe to grasp the concept, I learned this way back in the late 90s working for Blair Hull and his team, and they just thought, well, from a conceptual perspective, you can think of options being priced using the future value of the stock price. If the stock price is 100 today, what is the future value of $100? And if you go out 1 year from today, $100 would be worth, 100 plus the cost of carry, plus the risk-free return you could earn on $100. So $100 today at 1% over the course of the year would be worth 101 in the future. 101 would be that future value of $100 today. And so you can see as the interest rate goes up, it goes up to 2%, now you're at 102, that future value of the stock price goes up. And that may be one way to absorb the fact that as interest rates go higher, call prices go higher as those future values of today's dollars go up in value. And as interest rates go higher, put values tend to or will drop in price. Another way to think about that is when you buy call options, you are substituting a call for buying stock. You don't have to pay all that money for buying shares of stock. Instead, you can buy a call option that costs a lot less. It's worth more to you to buy calls when you can earn more on the cash you're not spending on shares. And so there's another way to think, and puts are the opposite, with the sense that you can keep cash in your account earning interest. So that's how to think of row having the different effect on calls and puts. And then row is larger for in the money calls and puts simply because of the monetary value of those options. As the price of the options decreases and approaches zero, then the monetary effect of interest rate changes has very little effect. You can just think of deep out of the money options that are worth nothing. Change in interest rates is not going to do much of anything for them. And by the same analysis, longer term options or leaps going out long term, they're going to have more premium, more time, and be more sensitive to interest rate changes. So row has its place, and I think where investors may most encounter row, not necessarily row, but the interest rate aspect, is using a calculator and trying to decide, well, what interest rate am I going to use? Specifically, the answer is the interest rate you're using is the risk-free rate of return that you can earn between today and the expiration date of the options contract. And that's what you're going to input into your pricing model to calculate options prices. And that should cover Theta, Vega, and Rho, hopefully pretty well. We've got a lot more material on these Greeks on our website. Optionseducation.org is where we're at. Lots of courses, podcasts, videos, webinars. We do our own webinars every month on various topics, sessions just like these, rotating the topics every month. And we've got a free service. Take advantage of this desk. The investor services guys, former traders and brokers, they all know the options product. They're not licensed to give advice or to talk about strategy, but questions about the product and what we have on our educational website, you can send them emails to options@theocc.com and take advantage of them. So it looks like we may have a few questions, but we do have time if there are. So if we do have some questions, Maria, I'll be glad to take a few.
Yeah. Thank you, Ed. Again, awesome class. I loved it. We do have a couple questions. Guys, if you're in Discord and you have questions, you can throw them there. If you're on GoToWebinar, you can throw them in the questions box there. We will grab questions from both sides. Enrico is asking, is IV related to the amount of volume or supply and demand in a contract?
Is IV related, what was the first part? Is it related to
the amount of volume, or is it related to supply and demand in a contract?
Okay, so IV comes from supply and demand, specifically in the contract. And I kind of like the way that question was worded. So volume is not a part of it. It is supply and demand, and it is specific to that contract. There is a different implied volatility level for every strike price, up and down. And that's where that volatility curve can be drawn by plotting the different implied vol levels across strike prices and connecting the dots. So it is for that options contract where you will get the implied vol levels. And going back again to the trading floor, this just reminds me, when I was changing implied vol levels on the trading floor, I was not moving implied vol levels up and down across all strike prices for a given expiration month. That was not what we were doing. I was noticing either supply or demand coming in for at the money options or out of the money options on the call side or out of the money options on the put side, and then moving implied vol levels at those parts of the volatility curve. On the trading floor, back for the first firm that I worked with, we called those out of the money areas the wings, like the wing of a bird. So we had at the money options, and then we had the call wing and the put wing, and we were moving implied vol levels based on supply and demand for those options contracts in each of those three areas. And of course, we could drill down even deeper and change the skew within one of those three areas as well. So it can get very specific. Direct answer to the question, not based on volume, it's based on supply and demand.
Okay, Julio is asking, doesn't Theta make up for Vega? If, let's say, some news comes out, the IV might get crushed depending on how high it was when you bought the call or put.
Okay, I may need to digest this one as well. Will Theta make up for Vega if IVol gets crushed?
Due to news.
Due to news. Well, let's see. So if IVol gets crushed and that works in our favor, then we're short options, and Theta should be working in our favor. So trying to grasp this this situation.
He's probably asking from a long standpoint, like,
yeah. Well,
how's it
if
on the table?
if you're long, Theta's working against you, and then the vol crush is also working against you. So if the question says, is Vega going to offset or counter the effect of the loss? I'm not sure exactly what type of position might be attached to the question, but certainly, I think maybe the answer could be intuitive. If you think about a specific position and you then can extract, well, you know that a long position is going to have long Theta, and you're going to lose Theta. I should say you'll lose on time decay based on Theta, and a long position owning options is going to suffer from drops or crushes in implied vol, and certainly the Greeks will offset each other. The stock price movements, the days changing, the volatility changing, those will offset each other or work together. And that's where I was kind of going with that. It would depend on whether you were long or short, but if you were long, I would expect you would say the Theta and the vol crush would both be working against you. But the position that you're thinking about would likely lead you to your answer.
Yeah, I agree there. Enrico, how can I tell if a contract will lose its IV or is expensive due to IV? Sometimes when market opens, contracts are much more expensive and suddenly drop remarkably despite maintaining the same price level on the stock, particularly, for example, in names like Amazon and Tesla.
Mm-hmm.
That opening IV spike.
The opening IV, that I'd have to maybe check and see where the IV was being, or how the IV was being calculated, what prices are being used to calculate the IV, because you certainly at the opening of any trading day would expect to see wide bid-ask spreads. And if you were calculating implied vol, for example, using some midpoint or looking at the offer price in some way, it may look quite different at the opening bell than when you're minutes into the trading day and the bid ask has really settled in. The midpoint's going to change, the bid and offers are going to change just as the market gets a few minutes after the bell and more participants come in and all that volume comes in. Then you can see really just no actual change in implied vol, but based on the way it's being calculated, reading those numbers sharp at the bell, you can see that volatility changing. And I think that question also asked, how do you know if it's expensive or not? And that's the ultimate question. That's what everyone's trying to figure out. It's rather difficult. I think most investors aren't doing the kind of analysis that it would require to come up with that opinion. It's very important to understand implied vol and to track it and to know where was implied vol when I bought this option, where did I sell it? But if you're going to develop an opinion on where implied vol is going in the future, you have to do some analysis on implied vol levels of the past, not just historic volatility, but where has implied itself been in the past? And that's a term I didn't mention today, but I call it historic implied volatility. The historic levels of implied, analyze that compared to today's level, and if it's higher or lower than its history, further analysis would need to be, the questioning of is there a good reason for that? And I had to do this all the time as a trader, and I spent some time trading a volatility fund. That's all we did all day long, was look at implied vol level today compare it to implied vol levels of the past. And if it was out of line in one direction or the other, it became a candidate for a trade, but we had to do deeper analysis and ask, why is it where it is today? Maybe there's a good reason. So it's tough to know, and you do have to have some knowledge of the stock and have a fairly sophisticated analysis put together looking at historic levels of implied vol and comparing it to today.
Awesome. Victoria, can you speak about using gamma to our favor on weekly options?
Well, I'd love to. Gamma is going to be a heavy focus in our second series part in 2 weeks. If you want to use gamma, just to forecast a little bit, you have this exploding gamma effect as an option closes in on expiration. Gamma is the change in delta as the stock price moves, and with less and less time, you have this exploding gamma where your options, especially at the money, are changing deltas by their largest amounts. They're going from 0 to 100 as the stock's moving up and down around the strike price. And the way to capitalize on this, potentially, if you are long an option, as the stock was trading, let's say, above the strike price. So you're long a call option, the stock's trading up above it. It's got 100 deltas, you've got very little time left, you could sell stock. And if the stock keeps going higher, you're protected there. You're long the option, you're short stock, your risk is protected. If the stock then drops, let's say, below your strike, and now you're at 0 delta, you can buy those shares back. And now you've actually just sold shares above and bought them below. And in theory, you can keep doing that. If the stock is bouncing around your strike price, you're scalping gamma, and you're taking advantage of this exploding gamma effect on expiration week by buying and selling shares if they're moving up above and below your strike price. If it's going in one direction, there's, that's an art form, trying to figure out where do you sell, and you don't want to sell too low, you don't want to buy too high. Where do you do that? And that's where some skilled traders will make decisions. When do they hedge their deltas? Quick? Do they hedge them right away, or do they wait? And that scalping gamma, especially on expiration week, is a way those professional firms try to make money. But they're very skilled at what they do in picking their levels to hedge deltas.
Okay, Teresa, you want to grab some questions from Discord because we're running short on time. I know that there are more questions over here on GoToWebinar, but we haven't hit any of them from Discord. So if there are some from there, we'll grab those and see how much time we have left.
So I think the bulk of them are over here, Maria.
Are on this side? Okay.
Yeah.
So then Adam is asking, so overall volume on a contract doesn't necessarily affect IV? Or does overall volume of a contract affect IV?
As my direct answer to that would be no. Certainly volume, it might be a reflection of interest or demand for a contract. And that you may notice some similarities between the two. But if you're setting implied vol levels, let's put it this way, you're not looking at volume. In fact, I think maybe one way to explain it, when there's new options on the board, let's say you get a new expiration date, you just finished a Friday expiration, you just get a new set of options. There's no open interest, there's no volume, there's nothing happening there. But as a market maker, I have to put a vol in there. I need a volatility level, and I need to make markets. I need to give these brokers bids and offers. And what you would often see, again, on the trading floor, is brokers would come in to quote options in a newly listed expiration, even if they didn't have any orders to buy or sell. They wanted to know from me, where am I setting my levels? And then they could take that back to their customers, and maybe their customers said, I think that vol's a little low, I'm gonna buy, or vice versa. And then as those orders came in, as the order flow was either on the buy side or the sell side, the supply and demand is what moved vol levels and changed theoreticals and moved bids and offers. You're not looking at volume. you're looking at supply and demand. And as I said, maybe you'll notice some correlation that higher volume means there's, I often, you could say maybe I notice that there's more speculating and maybe there's more buying in options that tend to have higher volume and higher open interest. And that, that's an opinion or an analysis that you might do, or an analyst might do. As an educator, I would say that volume is indirect, it's more interpretive, and it is supply and demand and the side of order flow that decides which way implied vol is going and where it ultimately settles.
Awesome. What time will internal theta drop? If end of day options have minus 37 next morning, does it lose 37 cents or half of it?
Yeah, good question. When does those theta happen? Does it happen instantaneously, or is it happening all day? It's actually I always say it's somewhat of a vague answer. Theta, time decay, is happening constantly. The theta is, again, an expectation or a way to predict what the value might be from today to tomorrow, but really time decay is happening throughout the day. And maybe the best way to explain that is think about expiration day. A stock price 100 and you're looking at the 100 strike call and it's trading for 50 cents at the opening bell on Friday. By the closing bell, if the stock hasn't moved at all, the value is zero. You've experienced 50 cents of time decay from opening bell to closing bell throughout the day. It didn't happen all at once, didn't happen at noon, it happened gradually throughout the day. So time decay is happening constantly throughout the day. If you're going out, say, and I don't know how far to go out, but weeks or months, then you don't have to be concerned with the fact that it's in fact decaying 1 minute at a time or 1 hour at a time. But if you're trading daily options or on expiration day, of course, you're inherently thinking, well, this option's starting the day worth 50 cents. I know it's going to be, there's going to be no time value left at the closing bell, and you have the trading day to try and capitalize on that options contract. So it's a good question. Theta is saying this is the expected amount of decay from one day to the next. But when does that actually happen? In reality, it's happening all the time and it's constant.
Awesome. And I know that we are out of time. We're coming up on 4:30 or 5:30 Eastern. I know there are other questions out there, guys. A lot of these questions we can answer for you in Q&A on Thursday. But Ed, thank you so much for an awesome class. Definitely appreciate it. Teresa, I don't know if you have anything last minute that needs to be asked.
No, I just want to tell Ed, I love his classes as always. Spectacular.
Same.
I cannot wait for the next one.
That's great. I can't wait as well. And if next week or next time is going to be Delta Gamma, probably a little shorter. So if there were some questions, we wanted to do a little more extended Q&A, we probably will have time to do that in a few weeks.
Awesome.
And Ed, really quickly, do you have a link where some people can go to get it's right there, optionseducation.org, if they want some additional information too?
Yeah, that's the website. If they want to send a question or ask someone, where can I get info on this or that, then they can send an email to the investor services team, and that email is right there, options@the.occ.
Thank
All
you,
right.
Ed.
Thanks again. We're going to go ahead and wrap up, y'all. Thanks for joining us. Ed, you're awesome. And we'll see you in a couple weeks. The rest of you, we'll see you bright and early tomorrow morning. Take care. Good night.